Hey, what's happening, guys? Dan Dowrow here with another Options and Play video update. So thanks to all of you that stuck around yesterday for our options session. In addition to just kind of going over what's been playing out across the market, we spent some time talking about earnings. And what I said last night is that I want to take the opportunity, like today and the next few days, to like use these videos as like kind of like a platform to like go through some like earnings ideas. Today, what I just quickly want to talk about is like short term hedges for earnings. Short term hedges would be more relevant if you're in like a swing position, okay, or like the underlying position. And obviously, there's some names maybe you want to try to stick with like over a longer period, right? So like Amazon, if you think it's going to turn the corner and put together a run, it could have some serious upside potential, but obviously earnings are going to be like a major wrinkle in the story, right? Like the company needs to deliver, but also obviously it has a history of pretty volatile swings around earnings. So it's either going to like make or break the rally potential. But say for instance you wanted to stick with like a trade on Amazon for several weeks or maybe even like a couple months, but you're worried that if earnings disappointed, the stock could get hit. Okay, so for me, short-term hedges are just that. These are like either weekly options or maybe like 2 weeks options. So these are just like options that expire um, right 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 around earnings. So like not too far out. I'm not paying like a ton of time value. And what I'm looking at for short-term hedges are it's like one of two things. Um, or excuse me, it's like one of three things. So I'm either looking at spreads or options that can at least make back the net debit. So if you're in options, it'd be like the net debit of the original position. So if you're in calls that cost $3, then I wanted to at least be able to make back $3 on the downside. So if I was looking at put spreads, I'd want put spreads that were at minimum $3 wide because I want to be able to make back at least the net debit of the long position. If you're in equity, it's a little bit different because your net debit, you're not going to have a net debit. You're just going to have your average price. In which case, you can use options to kind of like bracket your average price, right? So for Amazon, hypothetically, if your average price is 110, underneath that, right, your trade starts to go into like the red. So maybe you look at hedges around that 110 level because that's your break even, that's your average price, okay? Um, Now, when it comes to like the way to trade it, it's like for me, it's like I have the hedge on as long as like I need the hedge. So if Amazon were to maybe like have like a more muted reaction and the stock didn't really do much the following day, right? So maybe at the point where like the trade is not out of the woods, then I'd probably keep the hedge on and wait to see if it ended up rolling over. But if Amazon had a big gap up the following day, then I'd probably just dump the hedge because, like, I mean, for me, like the biggest catalyst was earnings. If earnings play out in my favor, stock moves higher. I don't really need the hedge anymore, right? On the downside, if it does end up gapping lower, right, and the hedge plays out the way it's supposed to, and you're able to make back the net debit of the position, well, then you have some things to consider. You can either close out the entire thing, right? Say like the breakout didn't work. I don't want to sit in this for a longer period, so I'm taking the hedge off. I'm taking the underline off. Or alternatively, you could close the hedge, right? It hopefully makes back what you lost in the underline or like the bull position, and then maybe you sit and say, like, okay, I still think Amazon could work higher from here, right? But now at least the hedge was able to make back what you lost. So it gives you some flexibility, but then you just really need to determine whether like the setup is still there. Okay, so um, I just feel like around earnings or big events, like short-term hedges can be kind of useful, but you just really have to have like a game plan with how you want to approach them because the last thing you want to do is just put more money to work and then watch like the stock not go up and the hedges not really play out the way you wanted, and then you end up losing money on both sides, which is not a great scenario. So make sure you got a game plan. Okay. So if you like this video and you're looking for more information about trading events with options, please follow up with the link in the description of the video for more information on options to play. Have a great night. Stay well, and I will talk to you all tomorrow.